Welcome back to Investing Talk Podcast.
Today we're looking at Unity software.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Right, so we really need to summarize what is happening with this company because it is, it's honestly one of the most confusing paradoxes in the market right now.
Yeah, you could say that.
On one hand, you have this invisible architecture of modern gaming. You know, if you play mobile games or if you use VR headsets, you are probably looking at pixels generated by their engine.
Right.
But on the other hand, for investors holding this stock lately, it feels less like owning a tech giant and more like standing inside a burning building. The stock is just tumbled.
Tumbled is putting it really politely, I mean.
It's bad.
I am looking at the charts, which we will definitely bridge over to and break down later, but it is a bloodbath. It dropped roughly 30% recently.
Yeah, it's a massive haircut.
So before we get into the nitty-gritty of the earnings and the balance sheet, help me understand the overarching, the so what here. Why shouldn't I just look at this as your classic falling knife situation, like don't catch it or you'll lose a finger, just run away?
That is the totally rational fear to have. And honestly, the price action totally justifies it. But the counter argument really just boils down to one word, and that is moat.
Moat? Okay.
Despite the recent crash, they remain the default operating system for creating 3D content. Think about the switching costs for a second.
They're huge.
Exactly. If you're a developer building a mobile game, you have built your entire physics engine, your lighting, your character assets, all your logic inside their ecosystem.
You can't just pack up and leave.
No, you really can't. You cannot just copy-paste your game into a competitor's engine just because the stock price dropped 30%. Code does not work that way.
Right. The developers are locked in even if the shareholders are panicking.
Precisely. The product stickiness is undeniable.
Well, stickiness is great. I get that Hotel California aspect of software ecosystems. You can check out, but you can never leave. But stickiness does not pay the bills if the actual guidance is bad. And that is exactly what triggered this massive sell-off. So let's transition into the fundamentals.
Let's do it.
They just reported their Q4 2025 earnings. Walk me through the actual damage, because a 30% drop usually means something catastrophic just happened under the hood.
So this is where it gets interesting. If you look exclusively in the rearview mirror, the car was actually driving just fine.
Really?
Yeah. They reported Q4 2025 revenue of $503.09 million, which was up from prior periods.
Okay.
And if you zoom out to the full year of 2025, revenue hit $1.85 billion.
That's billion with a B.
Billion with a B. This is not some small lemonade stand. The business is bringing in substantial cash, and operationally things were tightening up.
Okay, but you know the old rule. Markets do not trade on the rearview mirror.
They trade on the headlights.
Exactly. They trade on the headlights. And right now, the headlights are illuminating a massive deer in the middle of the road because the volatility we were seeing came entirely from the guidance. They came out and said they expect Q1 2026 revenue to be between $480 and $490 million.
Right.
But the consensus estimate, what Wall Street had already priced in, was roughly $491.78 million.
It was a myth.
It's a clear miss. Why should I, or anyone listening, trust a growth stock that isn't growing as fast as it promised?
I won't sugarcoat it. When you are priced for perfection, or even just priced for good, any slip-up gets severely punished.
Clearly.
But we need to peel back the onion on where that revenue is actually coming from. It's really a tale of two engines. You have the create solutions and the grow solutions.
And they behave very differently.
Very differently. Treating them as one giant blob misses all the nuance.
Let's break those down then, because I think a lot of people just hear the company name and think video games, but the business model is split.
Right.
So Create Solutions grew 8% year over year to $165 million. That is the subscription software, correct?
Exactly. Think of Create like your standard subscription software. You pay a monthly fee to use the tool to actually make the art or code the game.
Like an Adobe or Microsoft model.
Right. And growing that by 8% is solid, especially when you consider that the market is already pretty saturated. Most professional game devs already have a license.
So that's the steady part.
Yes. But the bigger beast here, and the more misunderstood one, is Grow Solutions. This grew 11% year over year to $338 million.
Wait, so Grow is double the size of Create?
It is.
That is fascinating because Create is the brand name everyone knows, but Grow is actually the cash cow.
Yes, Grow is their ad tech and monetization arm. This isn't the software you use to make games. This is the code that runs inside the game to show ads and manage in-app purchases.
Ah, I see.
And here's a specific detail that I think the bears are completely ignoring right now. Unity Vector.
Unity Vector. I've seen that name in their slide decks, but honestly, it just sounds like corporate marketing jargon. What does it actually do?
Think of it as a highly specialized sniper rifle for advertisers. In a post-privacy world where tracking users across the web is incredibly hard.
Because of the Apple privacy changes.
Exactly, because of those changes. Unity Vector uses the data from the game engine itself to predict which players are likely to spend money or watch an ad.
Oh, that's clever.
It is, and it now makes up 56% of the entire growth segment.
Wow, 56%.
Yes, it proves that their tech stack for ads is actually working. They are successfully helping developers make money, which in turn makes them money. If Vector was failing, I would say sell the stock today.
But it's growing.
It's growing. They solved the data problem.
I see the growth story there, and I appreciate the nuance on the ad tech side. But I have to put my skeptic hat back on and look at these margins.
Go for it.
I am looking at the gross margins, and I will give credit where it is due, 74.3%.
Elite software margin territory.
It is. It costs them very little to deliver the actual product.
For every dollar they bring in, they keep 74 cents before operating costs. That's the beauty of the software model.
But that phrase, before operating costs, is doing a massive amount of heavy lifting.
Fair.
Because when you look at the bottom line, it gets really ugly. The EBIT margins, earnings before interest and taxes, are still negative at negative 22.5%.
Yes.
And the pre-tax profits are negative at negative 39.4%. For a company that has been public for this long, losing nearly 40 cents on every dollar of pre-tax revenue is just hard to swallow. Where is all that cash going?
It is a harsh number, but you have to look at the why. They are not just lighting the money on fire in the parking lot.
I hope not.
They are aggressively reinvesting it. The free cash flow is being funneled directly back into AI development and subscription enhancements.
So no dividends.
No dividends, no buybacks. They are in a massive tech growth phase. Look at the balance sheet health. The debt-to-equity ratio is highly manageable at 0.7.
Okay, so they aren't drowning in debt.
Right? They are just spending heavily on R&D. In the tech world, if you stop spending on R&D, you are obsolete in 5 years. They are betting everything that AI is the next platform shift.
Spending aggressively is totally fine in a raging bull market. But when the stock is down 30%, investors want to see actual profit, not just promises of future AI dominance.
True. But again, that switching cost mode protects them while they transition. It covers mobile, PC, consoles, and XR. They are deeply entrenched.
All right, we need a verbal bridge to the technicals here. We have talked about the balance sheet, but the price action on the charts is where the real pain is right now.
It has been brutal for shareholders.
Brutal is an understatement. Following that Q1 guidance miss, the stock tumbled between 13.4% and 34%, depending on what day you checked your portfolio.
Yep.
Right now, the price is hovering around 30.36. That is down significantly from previous highs.
Yeah.
Looking at the volume and momentum, it just screams falling knife to me.
Or if you look at it through a different lens, it looks like pure capitulation.
Explain capitulation for the listeners who might not be familiar with the term.
Capitulation is basically when the absolute last of the sellers finally throw their hands up and give up.
They just want out.
Exactly. The pain becomes too great, and they sell at any price to stop the bleeding. When you see a drop of that magnitude in a short window, it clears the deck. There is literally no one left to sell.
So you think at 30.36 it's oversold?
Highly oversold.
But I noticed the volume surged on those big down days. Huge red bars on the chart. High volume on a drop usually confirms panic selling.
It was panic selling. But remember, for every seller, there is a buyer on the other side of that trade.
Who is buying that dip?
Retail traders and some smart institutions are viewing these 26 to 32% plunges as a massive discount.
Yeah.
If you believe the profitability story is still intact, buying at 30 feels incredible compared to buying at 45.
Do you have a technical target for a bounce?
Markets have a memory.
Yeah.
There are analyst gap fill levels around $41. If sentiment stabilizes just a little bit, a bounce from 30 back to 41 is a huge percentage gain.
That is a very big if. It relies heavily on sentiment. So let's transition over to what Wall Street and the smart money are actually thinking.
It's quite the battleground.
It is. I want to look at the sentiment here. Is anyone actually backing up the truck for this stock?
You have a real divide. It is pretty rare to see analysts this aggressively split.
Let's start with the bulls then. Who is sticking their neck out?
BTA is a big one. They have a buy rating with a $41 target dated February 17, 2026.
Targeting that exact gap fill level.
Exactly. And Citizens Market has an outperform rating at $37.
So they see clear upside. But the bears are incredibly loud too. UBS cut their target way down.
Yes, UBS cut all the way to $26, and Goldman is sitting right there at $27.
So UBS and Goldman are basically saying this is dead money, or it has even more room to fall. $41 versus $26. Why such a massive discrepancy? Are they looking at entirely different companies?
They're looking at different timelines. UBS and Goldman are focused on the macro headwinds in advertising, cyclical downturns. They worry that the growth segment might slow down.
And the bulls.
BTI and the bulls are looking at the AI product cycle and the long-term industry dominance. Some call it a meltdown worth buying. Others say it is still a sell.
What about institutional flow and insiders? Usually if a solid company drops 30%, you see executives swooping in. I checked the Form 4 filings, and there's no massive cluster of insider buying right now.
That is true.
That worries me. If the insiders aren't buying at $30, why should retail investors?
It is a totally fair critique. However, we did get a note from Wells Fargo recently.
What did they say?
They highlighted the company's ad network positioning amidst these oversold conditions. They pointed out that the market is severely undervaluing that specific asset right now.
So they see value hidden in the wreckage.
Right. And despite all the bearish noise on the chart, the underlying sentiment score based on fundamentals like their game dev dominance is actually tilting neutral to bullish.
Okay, I hear that. But I want to pivot to the risks. We have to do a proper risk assessment before we can give any kind of verdict.
Let's hear the bear case.
Risk number one has to be AI competition. Specifically, the elephant in the room, which is Google's Project Genie.
The AI narrative fear.
It is way more than a narrative. The fear is that generative AI could reach a point where someone just types a prompt like, make me a platformer game in a cyberpunk city, and the AI just creates a playable world.
Right.
If Project Genie lets you make a game without writing a single line of code in their engine, doesn't that entirely destroy the business model? Why buy a license if you have a prompt box?
It sounds terrifying on paper, but it really misunderstands how professional game development works at scale.
How so?
AI is amazing at generating individual assets, images, textures, little code snippets, but you still absolutely need a robust physics engine to make those assets interact. You need a logic layer.
So the engine is still required?
Yes. They are not running from AI. They are integrating it deeply into the create and grow workflows. So instead of Genie replacing them, their engine becomes the central interface where developers use all those AI tools.
You see it as an enhancement, not a replacement.
Precisely. Plus, the monetization edge. Even if you somehow prompt a full game into existence, you still need to sell ads and run an economy. Google has an ad network, but this one is highly specialized just for gaming.
Okay, I can see how they might co-opt the AI trend. Let's move to risk number two, which is dilution.
Nobody likes dilution.
Nobody. I saw a $508.27 million shelf registration for 17.49 million ESOP shares. That is a massive amount of new shares hitting the market. It dilutes existing shareholders. My slice of the pizza gets smaller.
It does. But you have to view that through the lens of the Silicon Valley talent wars.
Meaning what?
That employee stock ownership plan is exactly how they retain the top-tier engineers who are building this AI tech. If they stop issuing stock to employees, that talent instantly leaves for Meta or Google.
So it's a necessary evil.
It is a necessary evil to keep the brains in the building.
Painful, but I get it. Finally, risk number three, guidance and headwinds. We already know about the iron source headwinds. What happens if they miss guidance again in May 2026?
That is the big short-term gamble. There's also the macro risk of sector rotation, where money just moves out of software entirely. If they miss in May, the stock takes another severe hit, period.
So to recap all of this before we transition to the final verdict, we have a guidance miss, heavily negative EBIT margins, and real macro risks.
Yes.
But on the flip side, we have a 30% discount, incredible product stickiness, and a potential technical bounce to $41.
Time to make a call.
Let's move to the verdict. Before you give the score, remind the listeners of the Catalyst calendar. What is the next big event?
The next major earnings report is likely in May 2026. And here's the kicker. Consensus expects an EPS of $0.2.
Wait, a positive 20 cents per share?
Positive, which would represent a massive 166% year-over-year increase.
That is huge.
If they hit that, It absolutely proves the profitability turnaround is real.
So what is your final thesis?
My thesis is that the 30% plunge fully priced in these risks. The market overreacted to the guidance miss and completely ignored the long-term potential. They have dominant market share and a clear path to $2.3 billion in revenue by 2028.
I have to admit, those gross margins at 74% are just too good to ignore, even for a skeptic like me.
The cash flow machine is there.
So what is the bullish score?
Based on the research, I am giving it a bullish score of 7 out of 10.
7 out of 10 for a chart that looks like a cliff.
It's a prime swing trade opportunity into those Q2 earnings. Or, if you have a longer horizon, a solid multi-year hold for the AI and subscription growth story. The risk-to-reward ratio favors the buyer here.
A 7 out of 10. That's it for today. Don't forget to subscribe, like, and comment. We'll see you in the next one.